Think about your electricity bill for a second. Now imagine a business where the product depends on machines running almost non-stop, turning power into digital rewards. That's the world Coolbit Technologies is trying to enter as a public company. And on the cursor stocks, the question is simple. Is this a real business story, or mainly a bet on the crypto cycle? Coolbit Technologies Ltd. isn't a shopping app or a gadget you keep on your desk. The company describes itself as a crypto asset mining business, which means it sits behind the scenes, running or arranging the equipment that helps secure crypto networks and earn crypto rewards. The everyday thread is still electricity, machines, and whether the economics actually work. The company is young. It was founded on October 17, 2023, is led by CEO Jia-Jun Chen, and is headquartered in Richmond, Canada. That doesn't make it good or bad by itself, but it tells you this is not a decades-old operator asking for a bigger stage. It's a newer name, asking public investors to pay attention. Crypto mining can sound mysterious, but the simple version is this. Powerful computers compete to help process crypto activity, and the winners can receive crypto rewards. Coolbit's story is not about you using crypto at a coffee shop. It's about whether the company can run the machines, manage the contracts, and keep costs low enough to matter. Here's why the electricity bill keeps coming back. In mining, power is not a background expense. It's one of the main costs. If crypto prices rise and power is cheap, the machines can look attractive. If crypto prices fall or costs jump, the same machines can become a much harder business to justify. Coolbit says its core business is built around equipment leasing agreements with a partner and service agreements with third-party hosting providers. So don't picture one simple factory with a sign out front. Picture a chain of contracts. Machines, partners, hosting sites, power, and operating uptime. The money engine depends on all of those pieces working together. Now comes the IPO moment. An IPO is the moment a private company starts selling pieces of itself on the stock market. Coolbit is set for a pending NASDAQ listing on July 6, 2026, under the ticker CBAI, the short stock market nickname people use to find it. The planned price range is $4 to $5 per share. The company plans to offer 5 million shares, meaning tiny ownership pieces of the company, and raise about $25 million. Because the offer price isn't final yet, the clean way to read the math is this. $25 million divided by 5 million shares points to an expected price around $5 a share. Expected, not settled. This is where a lot of new investors get tricked. A $4 or $5 stock does not automatically mean a cheap stock. The share price is just one slice. What matters is how many slices exist, what the whole company is worth, and whether the business can grow into that price tag. If the IPO priced at the low end, selling 5 million shares would bring in about $20 million before fees. At the high end, it reaches the planned $25 million deal size. For a young mining company, that $5 million difference is not just a rounding error. It can affect how much room management has to operate. Why go public at all? Usually a company wants cash to grow, more visibility, and sometimes a path for early backers to sell later. For Coolbit, the public story has to answer a practical question. Can fresh money turn into better mining capacity, better contracts, or better economics when the electricity bill keeps running? The bull case starts with the demand for crypto infrastructure. People may argue about crypto prices, but the networks still need machines, hosting, and operators behind the scenes. If Coolbit can get reliable equipment, favorable hosting, and enough scale, the company could become more than a tiny IPO name. That's the hopeful version. But here's the catch. Mining is brutally practical. A beautiful crypto story does not pay the power bill. The company has to manage hardware that ages, hosting partners it depends on, and crypto prices it cannot control. That means the central question comes back fast. Is this a durable business, or a cycle wearing a company logo? Revenue is the money coming in before expenses. Profit is what's left after the bills are paid. Coolbit's latest full-year revenue and net income are not disclosed yet, so the financial scoreboard is not clear. That matters because investors are being asked to judge the machine before seeing how much money it has already produced. Market cap means what the whole company is worth on the stock market. For Coolbit, the IPO valuation has not been set yet. That's important. Without a full valuation and without disclosed annual revenue, you can't sensibly say the company is cheap just because the expected share price is around $5. Competition is also bigger than one named rival. In crypto mining, the customer dollar can go to other miners, hosting providers, equipment owners, or simply stay on the sidelines if crypto economics look weak. Coolbit has to prove it can win in a market where power costs, machine access, and timing can matter as much as branding. One more filing-style detail matters for regular investors. Who gets the IPO money? If shares are newly issued, cash usually goes into the company. But dilution happens, meaning each existing share becomes a smaller slice. If insiders sell, the cash may go to them instead. For Coolbit, selling holder and lockup details are not disclosed in the terms available. After it lists, watch 3 plain signals. First, does Coolbit explain its customers and contracts clearly? Second, does it report revenue and whether losses are manageable? Third, does the company show that IPO cash is improving mining economics, not just keeping the lights on? Those answers matter more than the first-day stock move. So the balanced verdict is this. Coolbit's IPO is understandable as a small public raise in a crypto-related business, but the proof still has to arrive. The dream is that it builds useful mining capacity while crypto demand grows. The doubt is that young companies in expensive, volatile industries can run out of room quickly. Come back to the electricity bill. If you understand the machines, the costs, the contracts, and the missing numbers, this IPO already feels less confusing. Follow the cursor stocks, and the next new ticker won't look like a mystery box. This video is for information and education only, not financial advice.